You've done everything right. You've saved. You have $40,000 sitting in a savings account, untouched, growing at a rate your bank calls competitive. It isn't competitive, it's losing. That's the first thing nobody tells you about saving, and it's the reason this video exists. Your $40,000 earns maybe 4% in a high-yield account on a good year. Inflation, over the same stretch, runs close to 3%. The real return, what your money is actually worth after prices rise, is close to nothing. Sometimes it's negative. You did everything the responsible version of yourself was told to do, and the money quietly loses ground every single year anyway. So slowly you never notice it happening in real time. You just notice eventually that the same $40,000 buys less than it used to, and you can't point to the exact day it started. This is the part that breaks the assumption most people are operating on without realizing it. Saving isn't the safe option, and investing isn't the risky one. Saving is the slow-motion risk. Investing, done a specific, boring way, is the actual safety. Habit 1. Confusing not losing with not risking. You put money in a savings account because it feels safe. The number never goes down. There's no chart with a red dip to stare at. No headline about a crash to worry about. This feels like risk avoidance. It's actually a different, quieter risk. The risk of your money's purchasing power eroding at a rate you can't see day to day, only after enough years have passed that the damage is undeniable. $1 saved in 2015 buys meaningfully less today. That's not a market crash. Nobody panicked. Nobody sold anything. The money just sat there, technically intact, technically safe, and lost real value the entire time. Investing carries visible risk. The number can go down, sometimes dramatically, sometimes for years at a stretch. That visibility is exactly why it feels more dangerous than saving. But over any long stretch of decades, a diversified investment in the market has historically outpaced inflation by a wide margin, while a savings account has, on average, barely kept up with it or lost to it outright. The risk you can see and the risk you can't are not the same size. The invisible one is usually larger. Habit 2. Treating investing as something you do later, once you feel ready. You tell yourself you'll start investing once you have more saved up, once the emergency fund is bigger, once things feel more stable. This sounds responsible. It's actually the single most expensive decision most people make with their money, because of a mechanism most people understand in theory, and almost nobody feels in their gut. Time in the market matters more than almost anything else about how you invest. $200 invested monthly starting at 25 versus the same $200 starting at 35 doesn't produce a 10-year smaller result. It produces a dramatically smaller result, because those first 10 years of compounding don't just add value. They compound on top of everything that comes after them for the rest of the timeline. The person who starts at 25 isn't just 10 years ahead. By 65, they can end up with nearly double the final total of the person who started at 35, despite investing the exact same amount every single month. The delay doesn't cost you 10 years of contributions. It costs you the compounding that those 10 years would have generated across the following 3 decades. Habit 3. Saving aggressively while investing timidly. You have no problem putting $500 a month into a savings account. The same $500 going into an index fund feels different, heavier, scarier, like a decision you need to research for another 6 months before you're ready. This asymmetry doesn't come from the actual risk profile of either option. It comes from familiarity. A savings account looks the same today as it did when you were a kid. An investment account has charts, tickers, red and green numbers, moving in ways that feel unpredictable even when the long-term trend is well understood. The result is that people who are genuinely disciplined savers, who could easily direct that same discipline into investing, often keep the bulk of their money sitting in an account earning next to nothing, purely because the savings account feels emotionally safer, even while the math says otherwise. Discipline isn't the missing ingredient for these people. Trust in the process is. Habit 4. Not understanding what an emergency fund is actually for, and overbuilding it as a result. 3 to 6 months of expenses in a savings account is the standard recommendation, and it's a good one. For actual emergencies, for the specific purpose of not having to sell investments during a downturn just to cover a car repair or a medical bill. The mistake isn't having an emergency fund. The mistake is treating the emergency fund concept as infinitely extendable, building it to 9 months, then 12, then 18, because it feels responsible and the number never goes down. So there's no obvious signal telling you to stop. Every dollar sitting in a savings account beyond what you genuinely need in a real emergency is a dollar that isn't compounding anywhere. It's not wrong to feel safer with a large cash cushion. But there's a real calculable cost to that safety, and almost nobody ever actually calculates it. They just keep adding to the cushion because more feels like more safety, without asking what that extra safety is costing them in lost growth over 20 or 30 years. Habit 5. Investing without understanding the one thing that actually matters: staying invested. The single biggest predictor of long-term investing success isn't picking the right fund or timing the market correctly. It's simply not selling during the periods when everything in you wants to. Markets drop, sometimes 20%, sometimes more, sometimes for a year or longer at a stretch. People who sell during these periods lock in the loss permanently. People who do nothing, who just let the automatic contribution keep running, typically recover and go on to see significant growth over the following years, because downturns have historically been followed by recoveries, often within a few years, sometimes less. The habit that separates people who build real wealth through investing from people who try investing and give up isn't intelligence or access to better information. It's almost entirely behavioral. The math works for anyone who doesn't interrupt it. Most people who tried investing and it didn't work for them didn't actually experience a failure of the math. They experienced a failure of nerve at exactly the wrong moment, sold at the bottom, and never gave the recovery a chance to happen in their own portfolio. Habit 6. Believing you need a large amount to start, so you wait until you have one. This delays the entire process for years in a lot of cases, and it's based on a misunderstanding of how investing actually works at the beginning. You don't need $10,000 to open an investment account. Most platforms allow you to start with far less, sometimes $1, and the habit of investing consistently, even small amounts, matters enormously more in the early years than the size of any individual contribution. A person contributing $50 a month starting today is, in the long run, in a stronger position than a person waiting to have $500 a month to invest properly, if that wait takes another 3 or 4 years to materialize. The habit of investing is the actual asset in the early years. The size of the contribution is almost secondary. People who wait for the right amount before starting often never actually reach a point where the amount feels sufficiently right, because that threshold keeps moving as their lifestyle and expectations grow along with their income. Habit 7. Comparing your investment account to other people's short-term wins instead of your own long-term trajectory. Someone mentions a stock that doubled in 6 months. Someone else made a trade that paid off spectacularly. This creates a quiet sense that boring, consistent, diversified investing is somehow the lesser strategy. Too slow, too unremarkable to be the real path to wealth. Most of the dramatic short-term stories you hear about are survivorship bias in action. You don't hear about the 10 other people who made the same kind of bet and lost, because losses don't get repeated at parties the way wins do. The habit of consistent, boring, diversified investing doesn't produce stories people tell at dinner. It produces results people quietly discover decades later, when the account that never made for interesting conversation turns out to be worth more than anyone at that dinner table would have guessed. None of these 7 habits look like mistakes while they're happening. Saving diligently feels responsible. Waiting to invest until you feel ready feels cautious. Building an oversized emergency fund feels prudent. Every single one of these habits is dressed up as good financial behavior, which is exactly why so many people build their entire financial life around them without ever realizing that the version of safe they chose was, over the long run, the more expensive option the entire time. Somewhere right now, someone is checking their savings account balance, watching it hold steady, feeling reassured by a number that hasn't moved. It hasn't moved. That's the problem. Everything else, prices, costs, the value of a dollar, kept moving without it.